Booyah! The energy in the financial world is electric, but today it's tinged with anxiety. The markets are buzzing, but not with the kind of excitement investors hope for. Instead, there's a nervous tension in the air, a sense that something big is brewing just beneath the surface. It's Thursday, January 8th, 2026, and your money's waking up to a sea of red. Across trading floors and home offices alike, investors are greeted by plunging numbers and flashing red tickers. The optimism that carried us through yesterday's rally has evaporated overnight, replaced by a sobering reality check. U.S. stock futures are down after yesterday's brief rally broke a losing streak. The market's mood has shifted from hopeful to hesitant as traders digest the latest headlines and brace for what's next. Every chart, every graph, every headline seems to point in the same direction, down. But don't panic. This isn't chaos, it's caution. What looks like panic selling is actually a calculated pause. Smart investors know that sometimes the best move is to step back, reassess, and wait for more information before making any big decisions. Investors are pausing, waiting for the next big move. Tomorrow's jobs report. This single data point could set the tone for the entire month, and everyone knows it. The anticipation is palpable as analysts pore over predictions and try to read the tea leaves. The market hates uncertainty, and right now it's like waiting for a storm you know is coming. You can feel the pressure building, the tension mounting, as everyone wonders just how bad, or how good, the news will be. The jobs report is the river card in this high-stakes poker game. Every investor is holding their breath, waiting to see if the next card will bring fortune or disaster. The stakes couldn't be higher, and nobody wants to make the wrong move before the cards are on the table. Until that card is revealed, nobody's going all in. The smart money is sitting tight, hedging bets, and keeping powder dry. It's a waiting game, and patience is the name of the game right now. Yesterday's optimism has faded. Today is all about defense and preparation. The mood has shifted from risk-taking to risk management, as everyone scrambles to protect what they have and avoid any unnecessary losses. Don't let the red scare you. This is the market bracing for impact, not collapsing. Volatility is a natural part of the cycle, and seasoned investors know that downturns are often followed by opportunities. Big money is getting defensive, and maybe you should be too. It's a time to review your portfolio, consider your risk tolerance, and make sure you're not overexposed to sudden shocks. The real fireworks are set for tomorrow. Today is just the build-up, the calm before the storm, as everyone waits for the jobs report to light the fuse. Today, it's all about positioning and protecting your capital. The best investors aren't just reacting, they're planning, strategizing, and making sure they're ready for whatever comes next. Understand the psychology. The market's a coiled spring, ready to snap on tomorrow's news. The tension is real, and when the jobs numbers hit, expect a burst of volatility in either direction. The decline in futures is just a sign of nerves, not disaster. Stay sharp, stay patient. Remember, the best opportunities often come when others are fearful. The main event is just around the corner. Keep your eyes on the prize, your emotions in check, and get ready for the next chapter in this market drama. The number everyone's watching? December's non-farm payrolls report. This report is more than just a monthly update. It's a critical indicator of the health of the economy. Economists, investors, and policymakers are all eagerly awaiting these figures. This isn't just a stat. It's the key to the Fed's next move. The Federal Reserve uses this data to gauge the strength of the labor market and to make decisions about monetary policy. The forecast 162,000 jobs added, down from November's 199,000. A lower number could signal a cooling economy, while a higher number might indicate overheating. A slowdown might sound bad, but Wall Street wants not too hot, not too cold. Investors are looking for a balance that suggests steady growth without triggering inflation. The Fed's been hiking rates to fight inflation, and a hot jobs number could kill hopes for rate cuts. If the job market is too strong, the Fed might continue its aggressive stance on interest rates. Too strong, and the Fed stays hawkish. Too weak, and recession fears spike. The balance is delicate, and the stakes are high. The market's walking a tightrope, hoping for a Goldilocks number. This means a figure that's just right, not too high to cause inflation worries, and not too low to spark recession fears. The sweet spot? Growth that's steady, but not overheating. This would indicate a healthy economy that can sustain growth without the need for drastic policy changes. The Fed's next decision, and the market's direction, hinges on this report. Everyone from Wall Street to Main Street is paying attention. Everyone's on edge, waiting for the data to drop. The anticipation is palpable as the release time approaches. Tomorrow, we find out which way the scales tip. Will it be a sign of stability or a cause for concern? The answer will shape the economic landscape in the months to come. The headline jobs number is just the start. Pros are watching wage growth and unemployment rates closely. Hot wage growth? That's a red flag for inflation and could keep the Fed on edge. If jobs and wages both cool, bulls will cheer for rate cuts. Bears will warn of recession. The market's reaction will reveal which story wins. Bad news is good news, or just plain bad. Every detail matters, not just the headline. Tomorrow's numbers will ignite the next big debate. Now let's zoom in on Samsung Electronics, a tech giant sending shockwaves. Samsung just warned its Q4 profit will plunge 35%. The culprit? Weak consumer demand for gadgets and chips. This isn't just Samsung's problem. It's a warning for the whole tech sector. If people are pulling back on spending, it's a sign of economic caution. The ripple effects hit suppliers, retailers, and forecasts everywhere. A 35% drop from a bellwether like Samsung is a wake-up call. The tech world's soft landing is looking a lot bumpier. Samsung's pain tells a bigger story. Their memory chip business boomed during the pandemic, but now there's a glut. Prices have collapsed. People aren't upgrading devices as often, and inflation has them holding on to old tech. The smartphone market is saturated. Upgrades are less compelling. Longer replacement cycles mean slower sales for Samsung and Apple alike. The chip division is drowning in oversupply while gadget demand is sluggish. It's a double hit: weak chips, weak phones. Even giants aren't immune to shifting consumer habits and economic cycles. The days of explosive tech growth are over, for now. Samsung's slump is a warning for the whole industry. Let's talk crypto, specifically Bitcoin. After a wild rally to 21-month highs, Bitcoin is finally cooling off. Traders are taking profits, and that's healthy. The surge was fueled by hopes for a spot Bitcoin ETF approval in the US. Now, with the decision looming, nerves are creeping in. Some are cashing out, not willing to risk a surprise. This dip isn't doom, it's just the market catching its breath. Bitcoin's next move hinges on the SEC's call. The speculation phase is ending, the waiting game begins. The crypto world is holding its breath. Why is a spot Bitcoin ETF such a big deal? It would let anyone buy Bitcoin like a stock. No wallets, no exchanges, just click and own. This could unleash a flood of new money from Wall Street and Main Street alike. An ETF brings legitimacy and security, making Bitcoin mainstream. The SEC could approve multiple big-name applications at once. The rally was all about this potential demand. Now, as the decision nears, some fear the reality won't match the hype. The market's in limbo, waiting for the SEC's word. Whatever happens, it'll set Bitcoin's next direction. Crude oil is surging again, and it's not just about supply and demand. Geopolitical tensions in the Middle East, especially after an Israeli airstrike in Lebanon, have traders on edge. Fears of a wider conflict could threaten oil supplies and shipping lanes. This geopolitical risk premium is driving prices higher. Higher oil means higher costs for everyone: fuel, transport, manufacturing. That's bad news for inflation, just as the Fed hopes to cut rates. The Middle East drama isn't just a headline, it's a direct hit to your wallet. Watch oil prices closely. They're a key market driver now. Instability abroad means volatility at home. As if the Middle East wasn't enough, Libya's largest oil field just shut down due to protests. This isn't just a local issue, it's a global shockwave. Libya, a key player in North Africa's oil scene, pumps out hundreds of thousands of barrels a day. When that flow stops, the world feels it. That's hundreds of thousands of barrels suddenly off the market. Imagine the world's oil supply as a giant reservoir. Now, a big tap just got turned off. Storage tanks that were once full are now running low, and every missing barrel adds pressure. Combine that with Middle East tensions, and you've got a double whammy for oil prices. The market is already on edge, watching every headline for signs of trouble. When two major oil-producing regions face disruptions at the same time, prices can spike in a heartbeat. The market's already tight. Now it's even tighter. Traders scramble to adjust, and volatility becomes the new normal. Every uptick in price sends shockwaves through the financial world, affecting everything from airline tickets to grocery bills. Think of it as losing both a waterline and opening a drain in the global oil pool. Supply is cut, and at the same time, demand keeps flowing. The balance is delicate, and even small disruptions can tip the scales. These shocks show how fragile the energy system is. Our modern world relies on a steady, predictable flow of energy, but pipelines, refineries, and shipping routes are all vulnerable to politics, to weather, to unrest. A protest or a drone strike can ripple worldwide. What starts as a local event can quickly become a global crisis, with consequences for economies and everyday people everywhere. Oil prices will be a major swing factor for markets in the weeks ahead. Investors, companies, and consumers are all watching closely, knowing that every move in oil can shift the entire economic landscape. If tensions ease, prices could drop fast, but if not, expect more pain at the pump. The stakes are high, and the outcome is far from certain. For now, every driver, business, and investor is holding their breath. Inflation, the Fed, and your portfolio all hang in the balance. The energy equation is more than just numbers. It's the heartbeat of the global economy. Booyah!